The syndicated loan market, though, could be the next area of financial distress. Here now, the co-author of a study on that issue, Professor Anurag Gupta, visiting professor of finance at NYU Stern School of Business. Professor, welcome. It's good to see you.
Thanks a lot for having me.
We talk about the next shoe to drop, and I guess we're talking at this point, there have already been a lot more than two, so I don't know whether it's a millipede or a centipede, but this is another thing we can start worrying about here?
Yeah, a little bit in some sense. We examine the equity returns of the firms that go and borrow in the market, and the ones whose loans have been sold over the last few years are the ones which have been sort of underperforming in terms of equity returns.
Yes. And
the extent of underperformance is to the extent of between 8% and 12% a year on a risk-adjusted basis over 3 years. So we feel that either some of these loans which were originated were not high-quality loans, and they were originated because it was easy to sell them off, something which is the same thing that has happened in the mortgage area. Or it could also be because once a bank has sold the loan, they don't really go and monitor the borrower as much, and that may be hurting the borrower.
So it's the same problem. The person that originated the loans doesn't have as much skin in the game at this point after it's syndicated?
Exactly. So it doesn't mean that they actually originated loans that were not high quality. It could be that they were not high quality, but it could also be that they were high quality, but once they were sold off, they did not go and monitor the borrower.
8 to 12% compares to what 5 years ago, historically?
This is the annual abnormal return of the borrowers whose loans have been sold, after adjusting for all other effects on equity returns. So over 3 years, it's a sizable effect. And just in our sample, which is more than 1,000 firms, we show that they have lost upwards of several $100 billion in 3 years.
Are these all? How are these being carried right now? Are these have to be marked to market?
No, they don't have to be, because these are mostly illiquid securities except for the ones which are sold in the market. So they are mostly still written at their historical values.
So who's got them? Where are they?
I think they're all over the place, because all of the institutions have been originating trillions of dollars of loans every year, and they are all over the economy. They're all over the world in some sense.
Where? In banks?
With all the banks.
Banks? Insurance companies?
Mostly the banks, actually, because some of the top originators in the markets have been banks, which is mostly commercial banks. But But over the last 8-10 years, also investment banks have been in this business. So all of the banks have these loans.
Compared to what we think of as the problem, the original problem, mortgage-backed or collateralized debt from mortgages, what in size, what percentage are we talking about? 10% of the total of the other stuff, or?
Approximately a third of these loans are usually sold. So about approximately 2/3 are not sold. And these are the ones which are actually underperforming. The borrowers of...
I'm just wondering how big it is compared to the problem that got us to where we are right now. I mean, it's going to be another shoe, but it's not as big as the original shoe.
Well, we document approximately $230 billion in loss in valuation over 3 years on the firms which are just in our sample. So if you extrapolate it to the whole universe, because of research reasons, we are restricted to a smaller sample because of data reasons. It could be several times of that in terms of the magnitude.
But banks, both here in the U.S. and European, Asian, it's a global.
It's global, but our results are only on U.S. firms and U.S. banks. The other issue, of course, is that it's actually a $3 trillion a year industry, and our results do not include anything from 2008. So this is only till 2007. So if you include information from 2008, I suspect it could look a lot worse than what it looks from our study right now.
Right. In the mortgage industry, you had the catalyst of home values, and when home values declined well below the loan value, is there such a catalyst in this area, in this industry?
We haven't seen any kind of a specific catalyst which has caused this. It's sort of a steady kind of trend over the years. Our sample starts in 2000 and ends in 2007. So the firms whose loans are being sold are the ones which are underperforming.
All right. Professor, thank you very much for coming in today and sharing this with us, I guess. We got another $250 billion onto our problems, but at least, thank you.
Thanks a lot for having me.
Okay.